Okay, and with this, I welcome you to our working paper launch on climate-related risk-taking, shaping, and shifting, how private financial actors keep stranding assets afloat. And I welcome you on behalf of our whole group of researchers and co-authors, encompassing, of course, Janina Urban, Simon Scheirer, Ricardo Baioni, and Nicolas Aguila, who are also in the room and not with us today, but also part of this group are Jan Fichtner and Joscha Wohlweber. And me, Paula Haufe, I have the pleasure to moderate this event. And I also want to use this moment to say a quick thank you to the Center of Sustainable and Just Transformation, short TRACE, which we have at the Witten-Herdecke University. Luisa Schwab is in the room. Thank you so much for hosting this working paper series and also for organizing these launch events. We're really glad that this is happening. Um, Now, I also have the pleasure to welcome our two special guests to this session, which are John Morris. John does a lot of amazing things and also very policy relevant things. In his current position, he is an assistant professor in economic geography at the University of Nottingham. He has previously been in Durham and Warwick at UCL. He's also the commissioning editor of the Colonial Hangover magazine. His interests are broadly in central banking, financial risk management, green finance, climate change, and just energy transitions. And has published in various economic geography and political economy journals and has written two books already. The most recent one is titled Mismanaging Macroprudential Expectations, How Central Banks Govern Financial and Climate Tail Risks. As John engages with how risk is constituted using discursive and calculative practices, and how these constructions of risk then emanate outwards to shape and remake geographies of the global financial system. We're super excited to have you here with this perspective and with this perspective on our work. It's really nice that you make time for this, and we're really looking forward to your remarks, John. Our second guest is Moritz Leiner, who I'm equally excited to welcome here. He is associate scientist with a background in organizational sociology and political economy and has been organizing campaigns targeting German energy companies and financial institutions for the past 3 years. He has done that as part of the German NGO Urgewalt, who is doing stuff on environmental and human rights. And amongst other things, Urgewalt produces these databases on the global industry called the Global Coal Exit List and the Global Oil and Gas Exit List. And they map expanding fossil fuel companies worldwide. It's super interesting and cool activism and research. And based on that, what Urgewalt does is then putting pressure on banks and insurers and investors to cut off funding to the fossil fuel industry. So that's super powerful and cool. And as you are probably knowing much of the industry's narratives of on engagement and divestment much more than anyone else in the room, we're also very excited to have you here with us, Moritz. We're really looking forward to your comments. And thank you both so much already for making time in your busy schedules. And speaking of schedules, we should be done in around an hour maximum. So there would be 20 minutes for Janina to present and then 7 to 10 minutes for each of the commenters. Then I'll stop the video and is the video on? No, anyway. And we'll be having a round of comments from the audience if there are any, and we of course hope that there are. All right, Janina, over to you.
Thank you very much, Paula, for this super nice introduction. And I hope you see my slides right now. Yeah, Paula gives me a nod. Yeah, so I'm very happy to present our paper that is called Climate-Related Risk-Taking, Shaping, and Shifting, Keeping Stranded Assets Afloat. And as Paula already mentioned, this is a joint work with my colleagues from the University of Witten-Herdecke, and it was part, or the paper is part, or presents the results of the research project that was funded by the Federal Ministry of Research from Germany. And today's schedule looks like this, if it lets me. Well, just a second. Ah. I'll already give you the structure. I'll shortly present the relation between risks and stranded assets. So what is the connection here of climate-related risk integration and stranded assets? Then I'm going to present to you the literature review and our analytical framework before telling you a bit about what the empirics of this paper is, and then presenting to you the strategies of climate-related risk-taking, shaping, and shifting, and narratives. Let me shortly try to figure out why this is not working. Maybe here. Okay, so I have to do this that way. Okay, this I already presented to you. And yeah, let me start right in. So what are we actually looking at? Our paper deals with the question how climate change and climate policies affect the financial sector, but also how the financial sector can itself be a driver of the decarbonization of the economy. And we are looking especially at the European Union because the European Union has been pretty much at the forefront of integrating climate-related risks into its regulations, but also has this approach of a de-risking approach whereby it tries to use the financial sector to leverage investments towards sustainable investments. And this topic of climate-related risks has been very much at the forefront of policy discussion in the last decade, one could say, but currently is facing quite some obstacles. So on the one hand, we have financial supervisors that are quite or still quite stringent on the perspective that climate change is really a risk and that the financial sector has to step up still on its assessment and also integration of climate-related risks. This article on the ECB blog by Sabine Mauderer from the Bundesbank, for example, refers to this very well-known speech by Mark Carney from 2015. And actually they say climate risks are no longer the tragedy of the horizon, but actually already take place today or materializing today. So that actually financial actors should be prepared right now to be integrating them and to bring climate change to the forefront of their management practices. And on the other hand, we have kind of a resurgence in fossil fuel financing. So while there was kind of a decreasing trend, which kind of made appear, okay, the financial sector is really taking seriously this challenge of climate change, we have this resurgent investment into fossil fuels. And our perspective in this paper is to ask, okay, why do financial institutions still invest in carbon-intensive assets, so assets that have been considered prone to stranding in the last couple of decades, and what strategies do they employ to address stranded asset risks? The literature has this definition, so we briefly refer to that stranded assets are assets that suffer from unanticipated or premature write-offs, downward revaluations, or are converted to liabilities caused by a range of environment-related risks. And the problem, and we are looking at the financial sector, so not how the real economy, but really the financial sector is dealing with stranded asset risks and stranded assets, that those can really hamper financial institutions' resilience and also overall financial stability. That has been made pretty clear by the literature. And very important in this regard is that the literature also converges on the assessment that climate-related risks tend to be underpriced for various reasons. So one is like more on a general scale that authors point out that the risk-based governance is incapable for addressing fundamental uncertainty related to climate change and the green transition, that there are very favorable risk-return ratios for carbon-intensive assets, so assets that have been considered prone to stranding, and that the integration of climate-related risk won't really change that much, so that there's a shift away from those assets. And then lastly, there's also a mismatch between what maybe policymakers be concerned with of stranded assets and what investors are capable or willing to integrate into their investment practices. So we say that where the literature has focused very much on the structural drivers of the lack of anticipation of stranded assets, our analysis examines the strategic behavior of financial actors, and that's what we then also conceptualize. We use an actor-centered approach to this problem. So this is where we kind of want to account for the agency here. And there's this very known paper by Colin et al. Who argue that there is a kind of divergence. So there is the differentiation between climate forcing and climate vulnerable assets. So climate forcing assets are carbon intensive assets. And we say that, okay, the financial sector can be considered as being invested into both kind of assets. So it's not really clear how the financial sector reacts to this climate characteristic of an asset. However, then we add two qualifications, right? Because we here draw on Valentina Osselatscheider, who has pointed out that this already assumes that actors really act on the materiality of an asset. And the whole strand of economic sociology, really has pointed out that this is not how actors really behave, but they imagine their future and they act strategically towards the future and the limits of knowledge. And then we also, nevertheless also integrate this materiality aspect, but we say, who said that already the climate-related materiality of an asset is something that then the financial sector will react or relate to? It can also be just the established risk-return logic without sustainability considerations. And based on this, we draft this decision tree that you see on the right-hand side. So our paper looks at the actors that actually do have some consideration of climate-related risks. And then we draw this decision tree from where actors ask themselves if a risk is acceptable. So whether the risk is in a good relation to the profit that they're expecting. And on the other hand, if the risk is negotiable or if they perceive it can be altered in some way, and we connect to these decisions, certain practices that have been very much discussed already in the literature, but we group them into strategy clusters, which we call risk-taking, risk-shaping, and risk-shifting. And these one will also be the ones that we've kind of clustered or empirical material against. To say a couple of words to the empirical data or the empirical approach we used. So we have a qualitative setup where we mainly base our analysis on semi-structured interviews. We have an actor selection. We already said we draw very much on the European sphere, but we also have a small sample case from the US. And we look at banks actually and institutional investors. And this is because we say that they are the ones that are mostly involved in the daily management of the bulk of global assets. And we have also some insurance companies as part of the institutional investors and rating agencies. We coded the financial practice deductively, so from the literature, and then the narratives we coded inductively. So we kind of really identified from the material what are relevant and recurring narratives here. All right. Then I already start with the first strategy. So remember when the financial institutions face or look at a certain assets. Sorry. Okay, there's one person that may need to be muted.
Ich glaube, ich habe erstmal keinen Überfall mehr.
Leo Mucci meint, okay, that person has already muted himself. All right. So we are in the first strategy of risk taking. So risk taking means that the risk is kept on balance sheets and the risk is deemed as acceptable. So this is the first category where we find, or the first strategy that financial actors are choosing. And the first example, or the institutional investors relate to these strategies in one of the following matters. So the financial practice of portfolio diversification and the adjusting terms and conditions are the ones that we group here into the risk-taking strategy. And here we found quite interesting material where it was about the finding that actually already existing, very established financial practices are kind of working for and against the integration of climate-related risk and also an anticipation or non-anticipation of stranded assets. I'm making that, trying to make that clear a bit more through those quotes here. So what this public asset owner is kind of reflecting upon here is that this person says, we kicked the tires on the Paris climate adjusted benchmark significantly, but at the end of the day, it was a non-starter, simply because the fund is so big that the concentration risk and turnover implied by it kind of eliminated itself. What served the fund best over time is broad global diversification, right? So for institutional investors or for capital markets, optimizing against the benchmark is the very established practice. And this is what then also, so this public asset owner tested how the diversification would look like if they integrated a sustainability factor, and actually found that from a risk perspective, they were actually much better off when they didn't have sustainability in their portfolio. So this is why this person said it was a total non-starter. For banks, we have a similar perspective that here diversification leads to kind of, to a, how you could say, a relative way, or making more relative the potential risk that could come from climate change and climate-related policies. So for banks, this person here says that transition risks are distributed across different actors. So if we just take a risk-based perspective, that's going to be too late to reach Paris alignment. So this basically means that banks that have to account for transition risks have certain clients that are in carbon-intensive sectors, so in that have assets that are prone to stranding. But like from the individual perspective of the bank, this risk is not something that they couldn't take. So in effect, this diversification leads those financial actors then to get maybe even less concerned about climate-related risks. And this can be problematic. And last, also for insurance companies, they are mostly affected by they're very affected by physical risks. And they find in the evaluation that the risk is not as big as one would suspect, because it's also spread out, because insurance business is a global one. And they say if there's a hurricane in the United States and at the same time a tsunami in Japan, then we're out of luck. So it's really shows kind of that the concern that there maybe was at the beginning about climate-related risks is kind of shrinking with this existing practice of diversification. Then we have the practice of adjusting terms and conditions of financing. And here we can say that financial institutions have partly increased the financing and insurance costs for their counterparties and for assets prone to stranding. However, they face a constraint, because if they raise the interest rates to their counterparties or the insurance fees, this makes a competitive disadvantage towards the others, and this is why they still insure fossil investments, or they also don't raise interest rates too much. So this is reflected in this quote here. Hence, this fossil fuel production remains insured across the board, it is insured. So this is something that was really like surprising to us, that because there were very much big news back then about exclusions, etc. And then we find in the interviews that because this branch of the economy only constitutes a certain part in financial actors' balance sheets, they say is something that the risk we can actually manage. So here it means the risk is acceptable. We just keep on doing what we did. And actually we find that financial institutions have also shortened their lending and holding periods. So they also, this is a way of keeping the image that they are very well insulated from the risk that may take place. So I need to speed up a little bit. The second strategy is risk shaping, and here we identified, or we linked the practice of company engagement and transition planning. So company engagement is something that has been there already beforehand, but it has very much been boosted by this sustainability, sustainable finance, and climate-related risk integration move. And what we found interesting is that some of the very many interviews from the European interviews from financial institutions said that they found EU regulation actually quite helpful, because it meant we could select the company based on where they stood in terms of sustainability, and we could push the ones that may be a bit less advanced, right? So in the era of passive investment and the role of index funds, it's quite hard for institutional investors usually merely follow indices, and this regulation in the EU helped them to actually pick certain companies and say, we engage with you and we are pushing you to be more sustainable. But then a lot of interviews found that the regulation wasn't enough. So I have here a quote which says that sustainability was considered part of the fiduciary duty, but this didn't really break with what with the established practice of optimizing against the market benchmark. So this is where the regulation really failed to come or to really stick with the financial sector. And with banks, we talk about transition planning, which has become a requirement in the EU. But the problem here again is also like quite structural, and which is summarized by this institutional investor. So this person says banks need to move these carbon intensive guys, but they also have to penalize them for the transition risk. So the nature of banks is a customer relationship. And here they really, this quote also by this bank says that there is a classic trade-off between customer relationship versus climate commitment. And this is something also, that banks kind of don't like to make so clear very much, that they have this trade-off, and there are various reasons why they don't follow up very much on the transition plans that they're drafting. So the limiting factors are the so-called differential riskification approach. So this is an approach by the EU regulators to very much trust on the risk models of the individual banks. Second, there's a so-called like micro-macro gap, one could say, where they have an overall portfolio assessment of the climate-related risks, but it doesn't really break down to the individual lending decision. And then they also they lack much more the sanction mechanisms that institutional investors would have. The last strategy is the one of risk shifting. So if we remember that the first decision was if the risk is deemed acceptable and whether it's deemed negotiable. And here we have a situation where there's really actors who say, okay, this risk is really too high. And we have various yeah, we have different actors, active investors and passive investors who deal with it in a slightly different way. And the interesting note we maybe have here, that divestment is still based on, you kind of have to see, you see the limit of this risk-based approach, where there's really a lot of uncertainty, but still actors say, okay, we don't like the look of it. And they say it's probably 50% art, 50% science. So there is a situation when they consider an asset that's prone to stranding or the risk from this asset is unacceptable, and they divest from it. But also here we have this limitation that obviously they don't like it because this costs them revenue. So in the words of this institutional investor, my motto always is that an investor who doesn't invest is not an investor. Well, for banks, divestment is not a very common practice, and they however, they draw on different mechanisms to engage in this so-called risk shifting. They can securitize their assets, and the EU regulation often tries to incentivize securitization of green assets, but what actually takes place much more is the securitization of carbon-intensive assets. So that's really something to look out for. And there's a newly emerging branch of an instrument that is called a significant risk transfer, where the risk of the potential climate-related fallout is insured. And this person here, this interviewee, acknowledges that doesn't really, or this is just moving the problem somewhere else. But this person says, at least you get to say, hey, I'm not part of the problem anymore. These were the 3 strategies. And now I'm briefly also present you the narratives before concluding. So we also identified 3 narratives, 3 recurrent narratives that we found were linked to mostly risk shifting. And so the first one is the transition finance narrative, and the second one, the portfolio decarbonization narrative. And the problematic with the transition finance narrative is obviously that it can blur the line between green, a dirty, and a transition activity. So this transition finance narrative was very much targeted at the regulative arena, the EU regulative arena, and enabled this or enabled a shift when it was about a penalization element that was about to be introduced into EU regulation. One can argue that it also makes sense to have transition finance and not penalization. However, what we say is that this, or what we can show is that this transition finance narratives really blurs the line, and it also pushes on the time horizon. So this person here says, our government set net zero by 2050. Why should I, as a private company, be stricter than the requirements set by my governments? And also portfolio decarbonization is something the portfolio decarbonization means that financial sector can decarbonize more quickly than the real economy, which at first doesn't seem to make so much sense, but there's ways that the financial sector can clean off its balance sheets, and this was really presented as a threat, and financial supervisors in the EU wanted to really prevent that the financial sector would engage too much in portfolio decarbonization. So transition finance and the portfolio decarbonization really worked towards effectively watering down, one could say, or shape EU legislation. And last, the collective action problem. I think this is a broader narrative because we also find it in the interviews in the United States, but it's about the financial sector is not the driver. And this comes up again and again. And certainly one could also say this is very much the case. But it's very interesting how in this so-called collective action problem narrative that we identified, we find that the financial sector is always delimiting its responsibility. We're all part of the problem, really. And it's also kind of hiding its profit motive that it has when it is still financing assets that are prone to stranding. So concluding, we find that risk-taking helps financial institutions to see climate-related risks as manageable, and diversification and shortening horizons can reduce their sensitivity towards these risks. With shaping delays decisive action, so despite regulatory advances, existing incentives such as benchmark-driven investing and banks' relationship or relationship nature of their business limits substantial financial shifts. And last, risk shifting allows financial institutions to exit assets prone to stranding. However, this mainly relocates the problem to have a limited effect on real-world decarbonization and is also potentially harmful for financial stability. All of that being said, this is in the de-risking approach that the USA or the European countries are taking towards regulation. So we really point to various instances where the financial sector is given task, which we try to highlight that it is not really fulfilling. Yeah, so this is the end, and thank you very much.
Thank you, Janina. I would directly hand over to John if you are willing and ready to give your comments.
Okay, perfect. Okay, thank you. So first of all, thank you for the extremely generous introduction, Paula. And I'd also like to, first of all, start by just saying thank you for the opportunity to offer some brief comments on this paper. I read anything and everything that this really fantastic team publishes, and I to add to the quality of it, I think that I just want to praise the productivity in terms of just how much high quality output they're contributing. I was reading this alongside the shadow banking paper Into the Light, and I was astounded to see that that was working paper 1, and we're on 5 or 6 now. So this is the amount of work that they're doing is really amazing. And you know, this stuff is really, really valuable and important for contributing towards our knowledge base and activism on just transitions. I also notice that Lucas Bogner is in the chat, and I gather that Lucas just passed his PhD defense. Is that right? So congratulations to Lucas.
Thank you.
Excellent. Okay, brilliant. Okay. So to focus on the paper, I'd say the high quality that I've come to expect from this group is once again present. This specific paper really is, in my opinion, it's really something special. You get these particularly rich insights from wide-ranging and extensively quoted interview data, and anyone who's had me as an anonymous reviewer for a journal will know that I'm the person constantly asking for the inclusion of extensive quotation from interviews, because I think that's what good qualitative data actually it gives you so much, and it allows people to really engage with it if you include it extensively, so that's great. Anyone familiar with my work will know that I'm always likely to approve of research that demonstrates how risk operates as a political technology, and I think the typology introduced in this paper of risk-taking, risk-shaping, and risk-shifting is really, really useful heuristic. I think particularly in terms of specialists in terms of communication to non-specialist audiences, which is critical when we think about the need for public scholarship and also to stimulate public opinion and activism in this area. I also obviously really like the focus on imagined futures and the roles that these play, particularly in doing kind of strategic work around risk. What I think is what I think this heuristic actually is really, really helpful for, and again, the presentation from Yanina absolutely foregrounded this for me, is thinking about how we can perhaps think about the technical tools of investment, accounting, and finance, and the role that these things play in doing important boundary work in terms of blurring practices such as risk-taking, shaping, and shifting. And I read the paper, well, my reread last night, and also this presentation now. I keep thinking about why we haven't thought more critically, I'd say more generally, as a community of scholars who are interested in critical finance and just transition, about the role of modern portfolio theory in these kind of practices of risk-taking, shaping, and shifting. And certainly engaging with this paper has got me to think through this. I'd like to push the team to produce an accompanying policy brief, one that details more on how weak de-risking regimes such as transition plans, climate scenario analyses, shadow carbon pricing, basically allow private financial institutions to shape and downplay risks. So that's not a criticism of this working paper, but it's a recognition that, you know, the really deep analysis that's offered here is a lot, and then to do really good policy recommendations is also a lot. And so I think a second policy brief would be really, really welcome here. I think what this focus on, say, how I think that what this would allow to do is to put out there as much work as possible on how we may harness things like transition plans, because obviously these are identified as a really important thing, but as this paper and the presentation from Janina shows us, these things are far from perhaps having the strength and the ability to coordinate expectations as much as possible. And here I'd kind of stress that in my own work with Hannah Collins, we're kind of really interested on the idea that risk shaping is a collective activity. It's also something that obviously the public sector and regulators and supervisors are trying to shape expectations, but the mechanisms that they use may introduce ambiguities, blurring, and not particularly be particularly effective at providing the kind of signals that financial institutions say that they need. I think that this work is really, really important because otherwise we risk transition plans becoming another example of mitigation deterrence instruments, such as scenarios have become, where people can tell a very, very optimistic story about diversification and the rest of it, and not one that perhaps shows us what's really going on. And then just to kind of say, I really want to like commend the attention to the wider financial system that this paper gives us, rather than just focus on banks. Obviously, banks are important, and it's correct that we really encourage public and give public the tools to scrutinize banks and their lending activities, and that's in relation to fossil fuels. That's also in relation to other things I would suggest, including the funding of weapons manufacturing. But I think what this findings in this paper foregrounds is that when one includes non-bank financial institutions and say private credit, risk-taking and risk shifting are always going to be happening within this interconnected system. So, and as Janina points out right at the end of the presentation, it's the key point really, I think, to play on the title of the paper, which is keeping stranded assets afloat. I think we may want to mix some maritime metaphors here and say that really what we're seeing is rearranging deck chairs, not on the Titanic, but perhaps on the Deepwater Horizon. And I think that this really future work could suggest ways regulators might want to look to, if there is possible, to firewall banking and private credit. There's some quite interesting problems with the way that private credit institutions morph in terms of practices and what they want to count as in terms of regulation. And so there's a lot of work to be done there, but I think that these guys in your team can do this. I have confidence in you. And as I say, the focus on this and on also in your first working paper that I mentioned earlier gives us this focus on private credit, which is really important. It's getting a lot of critical attention after the collapse of Tricolor and First Brands, even from The Economist in may, which is startling and does show you that a broken clock can be right occasionally. So I think that maybe it's understated in the paper, but I think the report does start to suggest that synthetic risk transfers go further than just undermine weak de-risking regimes such as in Europe, and also allow processes of arbitrage, and may do within stronger de-risking initiatives if this allows firms to arbitrage capital requirements, which I think is something is possible when you look at kind of how what the benefits of synthetic risk transfer are seen as to financial institutions. It's often about reducing the collateral requirements. I also love the idea, this focus on European credit practices, and I think this is becoming increasingly important as we are possibly seeing regulatory fragmentation, particularly around capital accord membership. And so seeing what's going on in Europe, I think is going to be really, really crucial, particularly when thinking around transition. Overall, I think the focus on private credit raises further questions and impetus for research about who is offloading these risks and who's taking them on, and the sort of work that Urgewald does. I think expanding it to the wider system would be really important, because ultimately, are we just seeing credit risk concentration? And if we are, well, this might help us to identify particular institutions that we may be able to put more pressure on, like pension funds, for example. And in my own recent policy work that I've done for the Institute for Economic Justice, I'd be very keen on anything that allows us to start looking at pension funds and saying, well, okay, if this is the sort of thing that pension funds are helping to enable, is there also the potential to levy forms of prescription on some proportion of managed pension money in order to support adaptation? So thank you for your patience. Thank you for your time. Thank you for the opportunity to comment. This is a wonderful piece of work. If anyone hasn't read it, please read it.
Thank you, John, for very thoughtful comments. I'm already looking forward to discuss these further. But before we do that, Moritz, would you also comment and provide your comments?
Yeah, thanks, and hi all. Thanks for the really great opportunity to comment on your paper today, and to also exchange on the work we do in academia, but also in civil society. And I just wanted to say that really reading the paper really felt like getting a backstage pass to the industry that usually prefers to speak in ESG disclaimers rather than in real understandable language. But just honestly, it's pretty illuminating. The authors offer a nuanced mapping of how financial actors approach the problem of stranded assets, or perhaps more accurately, how they try to delay approaching it actually. And also the breakdown of the different strategies, risk taping, shaping, shifting, was really clear and analytically sharp to me. And also, the uncovering of the stories finance uses to actually legitimize their business as usual. And for me, the question is, who buys the story of the financial industry actually? And from a civil society perspective, what follows from that? So I have a few points to raise, and the first one is on the portfolio perspective as well. So I think the paper really shows nicely how heavily financial institutions rely on portfolio level emissions metrics, and how these metrics often serve as a justification for not introducing stronger exclusion policies. To give an example, Deutsche Bank is a prime example of that actually. So their approach is like, quote, our portfolio emissions are decreasing, therefore we don't need more exclusions of fossil fuel companies. But for us, this portfolio perspective systematically misses one crucial dimension, namely fossil fuel expansion. It doesn't ask which of our holdings are still building new fossil fuel projects. And without asking that, you don't have a transition plan. You have a carbon accounting exercise and nothing else. For us as a civil society actor, this is a strategic clue. Focus on the expansion of the industry, not just the emissions. And that's really the fault line the finance industry prefers not to look at the moment. And my second point is an aspect on risk taking that John already hinted to as well. The article highlights the short-term perspective of many financial institutions, including insurers, what reflects also our experiences at Urgewald. Because this also explains why, when looking at the fossil fuel exclusion policies of insurers, we see that almost all of them are still insuring fossil midstream and downstream gas projects, such as LNG terminals and gas-fired power plants. So while obviously the long-term physical and financial risks are are clear, the practice really doesn't follow due to the short-term risk-return profiles those actors look at. But yeah, maybe to come to a more optimistic point on this, we could yeah, flip it and look at where pressure might be more effective, and yeah, to look at maybe asset owners, pension funds, foundations, endowments, like John said, might be fruitful also from a campaign perspective, because they think in a longer term, and because asset managers and insurers also depend on them. Influencing asset owners indirectly might change the entire chain in the end. So yeah, that's something I, as a campaigner, take with me. And third point I wanted to raise is on risk shaping. One of the most valuable contributions of the paper is showing how vague transition language actually is. Transition finance sounds tough and disciplined, but often it functions rather as a polite mutual fiction between finance and the fossil fuel companies. So it's kind of the deal: you do something vaguely green sometime in the future, and we'll keep calling your fossil fuel expansion a pathway to net zero. Yeah, and actually the fact that institutions still debate on whether gas is in or out as a transition fuel tells you really everything about the current elasticity of the term transition, and about the idea that private finance could drive the transition of the productive economy towards net zero by 2050. So once again, our point is clear here. We should look at fossil fuel expansion, and this should be really non-negotiable for so-called transition finance. And without ending the expansion, there's really no credible transition. So transition finance really needs no fossil fuel expansion norm aboard. So yeah, this kind of also brings me to the fourth point on risk shifting, where in the paper the authors outline narratives of financial actors who are skeptical of divestment, calling it not impactful and overlooking the collective action problem. Janina already hinted on that, while portraying themselves as neutral transition facilitators rather than transition drivers. Yeah, and although criticizing the delay tactics in such narratives, it seems to me as if the paper largely reflects what financial institutions say on that point, namely that divestment and exclusion as a risk shifting strategy enables financial institutions to keep stranded assets afloat. But empirically, I just wanted to raise some counterexamples on that point. So, for example, the coal sector, we saw there that divestment, and in particular the exclusion policies financial institution adopted, combined with also reputational risk campaigns from NGOs and also regulatory pressure, really had some real documented impact. There's a study from Berg et al. From 2022, which shows clearly that exclusions raised financing costs and delayed projects, and shrank also the investor base. Another quite late example is the controversial East African crude oil pipeline, the ECOP project, where the project developers, with oil and gas major Total Energies in the lead, will now have to finance nearly 90% of the project on their own, more than triple the amount that they initially planned to pay for, because they failed to attract really sufficient funding from banks. A problem with this, however, is that banks and investors might exclude a few high-profile projects, announce those loudly, and meanwhile continue financing expanding fossil players on a company level. So we think exclusions really must be done at a company level across the entire portfolio, not just the project level. And as this is not happening, this is also the elephant in the room for us. Something the paper hinted at in some quotes. One interviewee said, "How do I justify fossil fuel divestment when the industry is performing well?" And another said, banks may not just simply not want to walk away from the whole relationship with fossil fuel companies. And this shows us finance alone is really hesitant to deliver the transition. If policies don't change the risk return profile of fossil fuel investments, the financial sector will continue financing them, full stop. So markets really don't decarbonize out of moral courage. They follow signals, and finance can drive the transition to some extent, like I showed in the coal exclusions and EACOP, but we really need the strong political guardrails, and risk-based decisions, will just stay in the comfort zone. And but this, as we see in the current political situation with Trump's second term, we also see that the geopolitics have shifted to the right and climate policy has stalled, and regulatory uncertainty has grown rather than shrunk. So the risk landscape has really changed dramatically, which led to many financial institutions also to backtrack on their climate commitments, like the exit wave of the GFANs and sub-alliances showed. And also just a few weeks ago, Commerzbank has watered down its fossil fuel exclusion policies. So while the paper's insights are strong, a future follow-up could maybe account also for the radically shifted context and how the narratives and strategies around risk-taking, and especially risk shaping have developed in this context. But I see the time is running up, so yeah, just to sum up, yeah, thanks so much and for the insights, and happy to follow up on future discussions. And yeah, maybe just a last comment. We should really focus a lot more on fossil fuel expansions than just the portfolio perspective. Thank you.